welcome to this lecture. In this lecture, we'll be looking at section 5 of unit 2. And section 5 basically is talking about the subsequent measurement of financial liability. Subsequent measurement of financial liability. In section 4, we've looked at the subsequent measurement of financial asset, and we continue with the liability in this session. At the end of the session, our objective is to outline the measurement options of financial liabilities and when each option can be applied, and to apply the measurement rules to account for financial instruments. Then our third objective is to account for initial and subsequent measurement of compound financial instruments. So these are the objectives we are to achieve at the end of this lecture. Now, when it comes to financial liabilities, there are basically two categories or two bases for financial liability. The measurement bases are either at amortized cost or at fair value through profit or loss. Amortized cost or at fair value through profit or loss. These are the two measurement categories of financial liability. Let's look at the amortized cost. Now, financial liability are initially measured at fair value less transaction cost. Subsequently, they are measured using the effective interest method, and any financed or interest cost are charged to the statement of profit or loss, and changes in market rate are ignored because we are using the amortized cost. So your year-end liability would be equal to the opening financial liability plus the finance cost minus the cash that is repaid, and the result will give us the year-end liability. So this is how the amortization schedule for a financial liability looks like. So we have the year, just as we have under the asset. Then we have the opening liabilities. We have the finance cost, which may take account of the effective interest rate, which must be applied on the opening liability. Then we have the cash that is paid. Then the resultant will give us the closing liability. So to get this closing liability, it is the opening liability plus the interest of finance cost minus the cash paid, giving us the closing liability. So we say the finance or the interest cost is thus charges to the statement of profit or loss and the closing financial liability reported in the statement of financial position under non-current liability. So when we were looking at the schedule for financial assets, we said that the two main items we need in the financial statement is the finance cost, which is the effective interest rate if it is a liability, and then we have the closing financial liability. So this goes to profit or loss account, and this goes to the statement of financial position. Let's take an example and see how we solve questions in this regard. Now, example 14 in the book. Financial liability measured at cost with no transaction cost. So the question says debt is issued at 100,000 Ghana cedis and redeemable at 125,000 cedis. The term of the debt is 5 years and the annual interest is paid at 5.9% per annum. The effective rate of interest is 10%. required. Show how the value of the debt changes over its life. Now, this is the question given to us, and it is a debt instrument. We have been given the face value, which is 100,000. It's going to be redeemed at 125,000 in 5 years' time. The coupon rate or the interest rate per annum is 5%, and the effective interest rate prevailing in the market is 10%. So we are going to use this information to prepare the amortization schedule. And we said before you do that, you need to test the business model and then the contractual cash flow characteristics. If these two conditions are met, then we can apply the business model. Here we look at the contract that is to maturity at the end of the 5th year, and then the interest is going to be paid at the end of each year per annum 5%. So based on this, we can go ahead and amortize it using the effective interest rate. Okay, so if you are going to amortize it using the effective interest rate, this is what we are going to do. We have to get the fair value at initial measurement, which has to be fair value plus or minus transaction cost. And now this is a liability, so if there is any transaction cost, we have to take it out. But there is no transaction cost, so the figure still remains 100,000. Now the effective interest rate is 10%, so we apply 10% on the 100,000, which is giving us 10,000. Now with the cash that is going to be repaid, the interest that is going to be repaid based on the coupon amount of 5.9%, is going to be fixed throughout. So you calculate 5.9% on the nominal value of 100,000, which is giving us 5,900. So it's a payment, a deduction is going. So to get the closing financial liability, it is the opening financial liability plus the finance cost, which will go to profit or loss, minus the cash that is paid. What is left becomes the closing balance. Now the closing balance for this year becomes the opening balance for the next period. We follow in that regard, calculate the 10%. So we get to the final year, which is year 5. So opening balance for year 5 will be the closing balance for year 4, 119,028. Then when you come to the finance cost, I say you hold on with this. You can go ahead and calculate the 10% on the opening balance. But when you do that, because of rounding and co, there will be some difference which will be left at the closing balance. But we are saying that at the end of the at the maturity date, you are going to pay everything, the principal and the interest, and if there is any other premium. So you will not be owing any liability. And to make sure this place is zero, you have to get all the cash payment that is going to be made that particular the final year. Then you subtract the opening balance from it. Whatever is left becomes the difference, which becomes your finance cost. So there will be a slight difference between when you compute the 10% on it. So if you do that, you'll be having a balance of 13 left here. Okay, so let's look at the breakdown of this 130,900, which is the cash that you have to pay at the end of the period. Now, you borrow or you issued 100,000, but at the end of the 5th year, you pay back 125,000. So you have the 125,000, which is made up of the principal and then the premium that you are going to pay. Now I have this 125,000. Then you add the interest for the 5th year, which is 5,900 to it. So if you add the 5,900, which is the interest, to the 125,000, 200, you'll be getting the 130,900 here. So this is the breakdown of this figure: the redeemable amount and then the interest or the cash that will be paid for this year. So this is how you present the amortization schedule. Now you have to go ahead and then use it to prepare extract or the financial statement. So let's look at how it's going to appear when you are sending these figures into the financial statement. So when it comes to the statement of financial position, we say it is the finance cost in code that will come here. So when you look at it, year one, the finance cost we computed was 10,000, which is 10% on 100,000. So year two, it will be 10% on the opening balance. Year three, 10% on the opening balance for year three, and year four, 10%. Year five, 10% on the opening balance. So this is how we are going to present it. It's a finance cost, so it's a debit item. We are debiting the profit or loss account, which is an expense. So this is the finance or the effective interest rate column. When it comes to the statement of financial position, we are making use of the closing balance of the liability. So at the end of year one, what is the closing balance of the financial liability? We go back to the amortization schedule and pick that figure. Year two, what is the closing balance? Year three, what was the closing balance? And year four, what was the closing balance? At the end of the fifth year, you are paying back the liability, so the balance will be zero, meaning you have settled all the debt. So this is how you present it in the financial statement. So if you are preparing a financial statement and it is relating to a particular year, just look for that particular figure that will go to the financial statement and deal with it in that regard. Okay, now let's look at the other measurement criteria, which is fair value through profit or loss. Now, an entity has the option to designate a financial liability at fair value through profit or loss. Now, you have the option to do this if doing so eliminate or significantly reduce a measurement or recognition inconsistency. So that if there is any measurement or recognition inconsistency and you measuring it to financial profit or loss will reduce that inconsistency, then you can go ahead and do that. And this inconsistency is sometimes referred to as the accounting mismatch. Now if you do so, which would otherwise arise from what? Measuring assets or liabilities or recognizing the gain and losses on them on different bases. So if measuring it through financial profit or loss, fair value through profit or loss, eliminate the inconsistency that would otherwise arise. So if you are measuring it through other measures or other classification, inconsistencies will arise. By doing so, eliminate that. Then you can go ahead and then recognize it. The other option is that if the liability is part or a group of financial liabilities, so it's a part or a group of financial liabilities or financial assets and financial liabilities that is managed and its performance is evaluated on a fair value basis. So we have a group of financial liabilities or a financial asset, and these liabilities together are managed and its performance is evaluated on fair value basis. So in accordance with a documented risk management or investment strategy, and information about the group is provided internally on that basis to the entity's key management personnel. What we basically mean here is that When you have the liability, and this liability is part of a group, and this group we have financial asset and financial liability, and then it is being managed based on its performance and evaluated on fair value basis. If this is the case, then there has to be some documented risks in terms of management as an investment strategy, and then information about this group of assets and liabilities are provided internally on fair value basis, and this information is presented or provided by the entity's key management personnel. So you have to disclose it. Management have to disclose this information to the key management personnel, and if these are there, then you can go ahead and measure the financial liability at fair value through profit or loss. Now we want to look at the measurement of compound financial instrument. Now we say compound financial instrument is having a liability portion and equity portion. An example is the convertible bond. And if a convertible bond is issued, what we have to do is to split the instrument into its component part, that is a liability and then equity. Now the liability portion is estimated as the present value of future cash flows, assuming non-conversion. So if there is a future cash flow, we have to discount the future cash flows to the present value. Now the equity portion is determined as the difference between the proceeds of issue and the liability determined. So we look at the total proceed, we take out the liability, what is left is the equity portion. Now if the investor decides to exercise the conversion, the equity option together with the liability option is removed and recorded in share capital and share premium. So if the entity now or the investor decides to exercise the conversion, if that is the case, then we have to take the equity option together with the liability, has to be removed and recorded in capital and share premium. We'll take an example of a compound financial instrument. Now, Urban Limited issues a convertible loan that attracts interest of 2% on 1st January 2009. The market rate is 8% for debt without the conversion option. The loan of 5 million is payable in full after 3 years or convertible to equity. So this is a question. The convertible loan was issued on 1st January 2009 at a rate of 2%, but it's having a market rate of 8%. Now, the issued amount is 5 million, which has to be paid in full after 3 years. So what are we supposed to do here? We have to pass a journal to record the initial recognition of the loan on 1st January 2009, and B, prepare extracts of statements of income and statements of financial position at the end of 2009 and 2010. So the first thing we have to do is to split this 5 million into equity and liability. And to get the liability, you have to discount the future cash flows. So what will be the cash flows? Every year, you are going to pay an interest of 2% on this 5 million, and 2% of 5 million is 100,000. So the first year you are going to pay 100,000, the second year you are going to pay 100,000, the third year you are going to pay 100,000, the fourth year 100,000, up to the fifth year. Now we have the interest rate to be the market rate to be 5%, so this become your discount factor. you use the coupon rate 2% to get the cash flows, and you use the market rate as the discount factor. So you apply the discount factor. So this is going to be 1 over 1 plus 8% exponent 1, giving us this. When it comes to the second year, the discount factor is 1 over 1 plus 8% exponent 2. This is giving us a discount factor to 4 decimal places. You do it to the fifth year. Then, to get the present value, you multiply the cash flows by the discount factor, giving you the present value. When you get to the fifth year, at the end of the fifth year, the principal will be paid. So that year, you have the principal together with the interest, giving us 5.1 million. Then you get the discount rate at the fifth year apply, giving you a liability, a present value of this. Now the summation of the present value from year 1 to the fifth year give you a total liability. So when we add all this, you'll be getting 3,802,187. Then you take this amount from the total 5 million that was issued. The difference is the equity portion, 1,197,813. So what you did here is the splitting. So you have split it into each component part, liability and then the equity. So the liability is what you have to go. So this is the initial measurement. So subsequently, you have to amortize the liability using the effective interest rate. Okay. Now, this is how the amortization schedule looks like. We have the opening financial liability, which is the liability we got, the present values, the summation of the present values. Then you apply the rate of 8%, the effective interest rate of 8% on the 3,802,185. You get this. Then the cash paid, which is the cash flows, 2% of the 5 million will give us this. Then you get a closing liability, just as the first example we solved. You follow that throughout. When you get to this year, the same procedure still apply. The fifth year, you have to make sure you are paying 5.1 million. So the closing liability is 0. Good. Now let's look at how the journal entry will be. At the initial measurement, how are we going to pass the journal? So the journal is going to be, you are going to debit cash or bank because you are receiving cash. You are issuing a convertible loan. So the investors will bring cash and come for a certificate. So the total amount you are raising is 5 million. Then you have to credit financial liability. So the splitting is this. You credit financial liability with the 3,802,187. Then you credit the equity option with that same amount. Then you give your narration, being initial recognition of compound financial instrument split into component parts. So this is the first aspect of the question. What you are required to do, you have to pass a journal, and this is how the journal entries look like at initial recognition. The subsequent one is the amortization, and you use the amortization figures to prepare the extract. So this is how the extract look like. We have the statement of financial position, a profit or loss for 2009 and 2010. All you have to go and do is to go to the effective interest rate column. The 10% that you have applied on the opening balance, you bring that of 2009 and that of 2010. When it comes to statement of financial position, we are taking the closing balance of the equity still remains the same. So the splitting, you bring that same figure for year 1 it will be same for year 2. That one is not changing. However, the financial liability is changing, so you have to bring the closing financial liability at the end of year 1, then the closing financial liability at the end of year 2. This is how you prepare the extract. So in this session, we've looked at the measurement options available for financial liability, both at the initial and subsequent, and how to measure a compound instrument. Kindly read a manual, solve more questions to get understanding. Thank you very much, and let us meet in the next session.